Hey guys, interest rates are all the rage. Everyone knows a lending strategy is just as important as where to buy and what to buy. So in this episode, it's going to be a massive one. We're going to talk about how to cut your mortgage in under 30 minutes. Yep, that's not just clickbait, that's true. And the second thing is 2 new ways to increase your borrowing capacity for property investors. Okay, so look, these are not just meant to be fantastical titles and headlines. We're actually going into how to reduce your mortgage and how to borrow more if you are cut out, if you are capped out. So carry on listening. I'm so grateful that you're here with me, whether you're walking your dog, you're at the gym, you're cooking, you're just randomly doing stuff with your earbuds on, with your earpods on. I'm grateful for lending me your ear, and hopefully this is going to take you 1, 2, 3, 4, 5 steps towards your financial happiness, towards your financial freedom. All right, let's get into it. Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you. All right, so first of all, how to cut your mortgage in under 30 minutes. You know, seasoned investors, they don't actually complain about interest rates because the truth is there are ways to reduce your bank interest rate by a lot, even when the RBA seems to constantly increase them. How? Like this hack could be the difference between you buying your first or next investment property versus being a slave to your 9 to 5 for literally the rest of your life. Big statement, right? Well, it's true and it's completely free. So here we go. So let's say you have a home loan. Let's just call it with CBA, the Commonwealth Bank of Australia. All right, so what you do is first of all, you make sure that it's a variable rate, okay? It's a fixed rate, you can't really do much, okay? It's a fixed rate, can't really do too much. If it's a variable rate, right, what you do is step 1, you just go online to your internet banking and figure out what is the rate you're actually getting. First of all, you figure out what interest rate you're getting. You need to know what your baseline is, right? So let's say you're getting 4.5%. 4.5%, cool, that's fine. You're an established customer, so new customers are probably getting somewhere like high 3s or low 4s. New customers always get a better rate at basically every bank than existing customers. That's how they get new clients. That's how they tempt more people and get more business. Remember, banks are there to make money. The way they make money predominantly is by giving loans and earning interest. That's just how banking has worked for many centuries. So you figure out what interest rate you're actually getting, and once you know what interest rate you're getting, then you know what baseline you can negotiate off. Second step is it's kind of painful, but it doesn't take too long and it saves you thousands of dollars. You just pick up the phone, right? And you call the bank. And okay, it's all right, well, that doesn't make any sense. Well, what do you do next? You tell the bank that you want to leave, all right? So what I do normally is I call the bank up and I say, look, mate, right now I'm getting 4.5%, okay? I want to refinance my loan to another bank that is giving me 3.5%. I normally just go a whole percent less, okay? Regardless of whatever's going on in the market, I go a whole percent less. And I say, I want to get 3.5%. Can you issue me a loan discharge notice? This is very important. You have to tell them this. You need to ask them to issue you with a loan discharge notice. These 3 words are like magic, okay? These 3 words will save you tens of thousands of dollars in the long term, okay? A loan discharge notice, that means that you're officially asking them to basically can your loan, and you're going to take your business to another bank, regardless of whether you have talked to another bank or you're just making this stuff up, to be honest. That's what I do as well. And all of a sudden their ears perk up and they're like, oh my God, all right, well, sir, let me see what I can do for you. And they normally put you on hold for like a couple of minutes and like pretend to, do stuff. Just like when you're buying a car and you're like, oh, I want this, I want a better deal. And they kind of say, I need to speak to my manager. But really they just go into another room and ruffle papers around and come back as if they spoke to a manager. That's what these people do, like on the call. Right? You might need to hold for a while. They come back and they say, okay, well, we can give you 0.2% better or 0.3% better than what you currently have. We're not buying that. We're not stupid here, right? We're seasoned property investors. So what you need to do is say, look, that's just not acceptable. For me, I need that whole 1% less, to remain in your books, to remain as a customer in your books. That's when they'll really put you on hold and actually talk to their supervisor, actually talk to their manager. Okay, you might need to be on hold for like 5 minutes or something, but it's well worth it. And that's when they'll come back. And I would say, like in my experience, I can only share my experience and perhaps the experience of my clients, probably 6 or 7 times out of 10, they will come back and actually give you that whole 1% less. Why are they doing that? It's because of something called net interest margin. Net interest margin is the margin or the difference that banks make in terms of the cost of them securing their funds and the cost that they pass on, or the revenue, the interest rate they get from loaning it to you. Their net interest margin right now is being squeezed. The cost of funds in global capital markets is going higher and higher. Of course, local interest rates are going higher, so they're making more money. But on a margin basis, on an average margin basis, what you find is in the last 5 years, the net interest margin is really eroding. So banks want your business, like they're desperate for your business, especially second-tier banks, third-tier banks, which are in no way higher risk than, your big 4 banks at all. But this strategy works with all banks. So that's all you do. And they come back and you've effectively just got a whole % less in your interest repayments. Now, you might be lazy and think, I've already got a loan, I've already got 2 loans, 3 loans, I can't be bothered doing this. But seriously, I'm not getting anything out of it. You have to just spend 10, 15 minutes. First of all, internet banking, figure out your current rate, call them. You might be on hold for like 20 minutes, fine, right? But after that 20 minutes or 30-minute process, you've just saved yourself, like, let's say you've got a $500,000 loan, $400,000, $300 million loan, whatever it is, you're saving yourself tens of thousands of dollars over just a few years, but hundreds of dollars per week, right? Like, who wouldn't do that? And then all of a sudden, you've gone from being able to afford no more properties to being able to afford more investment properties. You've gone from being able to, not even afford one investment property to being able to afford that one investment property. So like my own experience across like 12 properties is that, I'm not just making this up, I swear to God. My interest rates, even though real interest rates, official cash rate has risen like, more than 2.5% in the last literally 6 months, my interest rate, the interest rate that I'm paying, hasn't risen more than 1%. Okay, so I'm beating the market by more than 50%, and that's just because every 3 months I'm employing this strategy. Now, of course, there's a limit to it, right? You can't just like keep going and get negative interest rate. Like, that's a bit silly. But take the principle from what I'm saying. If you're on the sidelines, not investing in property, because you're making your mind up based on what friends or family or the media is telling you, those people don't know these more intricate secrets. I'm reticent in even saying or calling it a secret because it sounds like it's some sort of esoteric truth. It's not. It's just uncommon sense. It's common sense, but it's uncommon. And that's how banks make money, because most people don't know these strategies. All right. So you should know these strategies, and you should be able to not only make money from property investment, but also save money through these methods so that you can build a portfolio which is larger and larger and larger. Yes, interest rates are rising. We've just had the most recent interest rate rise, which is 0.25%. So they'll probably not rise for too much longer, too much severity. But still, like, even when interest rates start plateauing and dropping and everyone piles back into the property market, what I've shared with you today, the sort of 2 to 3 step process of simple phone call, that saves you money. That, it could just be the difference between you getting that additional property, which in the next 10, 15 years doubles or triples in value, and all of a sudden you can retire, or all of a sudden you can live a life of, somewhat more comfort or luxury, or, all of a sudden one spouse, husband, wife, or whatever, they can stop working. Just these small decisions, they add up. People are really fearful of taking the next step in property investing because they don't know what the next step is. It's like, all they see is retirement in 15 years, but so much contradictory information. There's so much misinformation. They don't want to be scammed. They don't want to be hurt. They don't know what the property market is going to do. You can't implement or action anything from that mindset. You need to break it down into what is the next step. Okay, now the second part of this episode, 2 new ways to increase your borrowing capacity. So 2 banks just changed their borrowing capacity policy. If you've run out of borrowing capacity, then you gotta watch this, And especially if you're a business owner, you don't have to be, but I'm going to go into a hack for business owners, because if you're a business owner and banks are not lending you money, then this may well be the silver bullet for getting additional borrowing capacity. Either way, this is very exciting news, so here we go. The first one, real quick, the first one is from NAB. Now, what they've done is normally banks, what they do is they say, we will shade your rental income by 20% in order to calculate how much you can borrow. So if your rent is, let's say, $24,000, they'll shade it by 20% down to, what is that, thousands of dollars less in order to calculate the true borrowing capacity that you have. They've just changed that to just shading it by 10%. Now, that might not sound like, all that much really, but that gives you an additional borrowing capacity of around 8%. So, you might just be on the cusp, you might be able to borrow $250,000, and that may not be enough to get a decent property. Now, this will allow you to perhaps just borrow just that bit more with your deposit as well, gets you into the 300K category, which gets you a really good, high-yielding, high-growth property. So that's the first one from NAB. Whether you're going through a broker or you're going yourself, go check out NAB. It's a big difference that it will make to a lot of you. Now, this second one, I'm even more excited about. Now, what this is Virgin Money. Everyone knows Virgin, right? Virgin Money is owned by Bank of Queensland. Now, Bank of Queensland is a tier 1 lender. They give tier 1 lending rates. In other words, the interest rates are low. They're not like your First Max, your Pepper Moneys. They're not like your higher interest rates. The non-bank lenders allow you to borrow a little bit more, but they charge you a premium on the interest rate. Now, what's amazing about Bank of Queensland owning Virgin Money, they've just changed their DTI, their debt to income ratio. So before, Virgin Money would only allow you to borrow up to 6%, on a debt to income ratio, not 6%, sorry, that's a ratio, right? So debt to income up to 6x. They've just changed that to 8x. So that will allow you guys to get so much more borrowing. And the great thing is, because Virgin Money is owned by Bank of Queensland, even though they're giving higher debt to income ratios, allowing you to borrow more, the interest rate they're charging is actually just the same as a tier 1 bank, like a CBA or ANZ or something like that. Okay, so you're getting more money from the bank at a cheap rate. Now, that's amazing. And then the second part of this Bank of Queensland Virgin Money story that my broker friend told me is, if you're self-employed, normally if you're self-employed, you had to show 2 years of tax returns, and the bank would take the average salary or the average income from your business and assess your ability to borrow money on that based on 2 years. Now, there's just been this change from the same bank, right, whereby they're allowing people, even though their income may have been really poor, in that 2-year period, they're allowing you to borrow money so long as you have two options available, okay? So long as option one, you have two pay slips, i.e. the company that you own, you're drawing a salary from, you have two pay slips to yourself, and you get an accountant to sign off on the fact that it's a healthy business, okay? That's scenario number one. And the second scenario is that you have 3 months of salary to declare, okay? And they'll assess you based on that 3 months of salary, even if 2 years ago or 1 year ago your business wasn't that solid. Now, of course, you do need to be in business, have an ABN for 2 years, but they don't no longer care necessarily about how your business is performing. So there'll be like thousands of people out there, tens of thousands of business owners who, you want to get a loan, you want to begin or expand your property portfolio, but because you're not a PAYG, you're a business owner, not having 2 years of good income is holding you back. Now, with Bank of Queensland Virgin Money, there's not a problem. Option one, go to your accountant, get them to sign off on it, and all you need is two pay slips to yourself of a reasonably good enough or appropriate income that you're paying yourself from the business. Or option two, 3 months of salary. You don't need an accountant to declare or sign off anything on that. You just need 3 months of consistent income that the business is paying yourself. So this is extraordinary. Interest rates are going up. I think they're almost at the top of the cycle, but it has meant that borrowing capacity has shallowed out, has softened out, and that's meaning that a lot of you guys may not be able to borrow as much or anything enough for your next property. These two hacks that I've just shared with you, the first one with NAB, increasing your borrowing capacity by almost 10% overnight, and the second thing with Virgin Money, Bank of Queensland, increasing their debt to income ratio and allowing you to borrow more on a PAYG basis, and allowing business owners to borrow so much even if their business income hasn't been solid for 2 years. This is a game changer. And guys, in every cycle, this happens, right? In every cycle, this happens as interest rates go up. Borrowing capacity levers, borrowing capacity tactics, borrowing capacity policy changes occur, offsetting a lot of those interest rate rises insofar as being able to borrow money. Now, I fully expect, I'm on record here, I fully expect that in the next probably 3 to 6 months or something, like 8 months maybe, that buffer that banks put on you to make sure that you can repay your loan. They put a 3% buffer on. So if your official, if the lending rate is 3%, they assess you at 6%. That buffer that was forced upon the banks by APRA, the regulatory authority, back when interest rates were zero, almost zero, that buffer is going to be shrunk. And why is that? Is because we needed a buffer to withstand interest rate rises because they were at a record low. So APRA very intelligently said, well, interest rates are only going to go up, right? This was last year. Let's imply or install or implement a buffer so that when we come into this situation where interest rates have gone up, people are still good because banks have assessed them at 3% more than what they ought to. Now there's no need for that because there's almost zero possibility of interest rates going up another 3%. Of course, the CBA is saying they might go up another 25 or 50 basis points. Other banks are saying maybe another 100 basis points or 1%. But there's no way they're going up another 2 or 3%, right? Or something dramatic would need to happen. So that buffer is going to be shrunk back down to 2%, which is what it used to be, maybe even less. If we're at record in this cycle, we're at higher interest rates. So, that all of a sudden will allow your borrowing capacity to expand organically overnight by 10, 20, 30%. Alright, so hopefully that brought you a ton of value, guys, how to improve your borrowing capacity and how to cut your loan. All of that was completely free, and I absolutely love it when you guys leave a review. I'm getting so many of them these days, more than 100 reviews now on iTunes. One recent one that I had was, "Hi, if anyone wants to get into property investment based on actual data rather than just speculation or guesswork, I highly recommend PK. CBA. He has a wealth of knowledge, and when it comes to property investing, you will learn something new every time when you listen to him. So I'm so grateful for being with me, for leaving those reviews on Spotify or Apple Podcasts. I think it used to be called iTunes. Thank you so much, guys. I'll see you next time. Catch you later. Bye.